Today we're going to look at Chapter 8, which is on receivables. There's two main sections in this chapter that we're going to talk about. We're going to talk about accounts receivable and how to write off accounts that are not going to be collected. And we'll also introduce the concept of notes receivable. This chapter has a total of 8 objectives, but we are only going to be covering the first 7, and the majority of them are very small. The bulk of this chapter, where I would spend a lot of my time, is in Objective 4 and in Objective 6. Objective 1 says describe the common classes of receivables. There are 3 common classes. The first is accounts receivable, and these are normally short periods of time within like 30 or 60 days, depending upon what the company has set as their policy. The second type is a note receivable. A note receivable is a much more formal instrument, and it's for longer periods of time, and normally involves interest, and it's for a set amount of time as well. And then the third classification is what we would call other receivables. These are things like interest receivable, taxes receivable, those other things that don't happen on a daily basis. Okay, Objective 2 describes the accounting for uncollectible receivables. It says businesses will incur an expense when customers fail to pay. There are 3 common account titles used in recording this expense, and those 3 common account titles are called uncollectible accounts expense, bad debt expense, and doubtful accounts expense. Those are the 3 most common types of ways. So first we'll talk about what's up on the board here, which is factoring. Factoring is when a company can sell the receivables, and they usually sell it for less than its value, and then that way they don't have to take on the responsibility of being the debt collector and calling the customers and trying to get them to pay. So they may actually sell it to a third party who then will give them, like if they have a $10,000 receivable, they may sell it to them for $8,000, and then the company will take on the responsibility of trying to get the $10,000 out of the customers. Okay, so again, here are those 3 common expense accounts: bad debt expense, uncollectible account, doubtful accounts. They're all the same. It just depends upon which wording the company chooses to use. All right, there are a few indicators on what would make an account uncollectible, and this is the fact that the receivable is past due. They haven't paid it on time. Customer does not respond to the company's attempts to collect. Customer files for bankruptcy. The customer closes its business, and company cannot locate the customer. These are some very common examples of when we will know that it is time to actually write off a receivable because we do not expect to receive the money. Okay, there are 2 ways that we can write off a receivable. The first is the direct write-off method. This method is not used very often, and it is only used by those companies that don't have very many receivables, things like doctor's offices and lawyers' offices. And then the most common way is the allowance method, and that's Objective 4, where we're going to spend a majority of our time. Okay, Objective 3 is describe the write-off method of accounting for uncollectible receivables. Under the direct write-off method, the expense of an uncollectible account is recognized when the company decides that further collection efforts on a delinquent account are useless. And so once we've decided that we do not expect to receive this money, we just write it off. And it looks exactly like what you see right there in your book as well. May 10th, we've decided that there's no chance of us collecting this receivable from Ross of $4,200. So we put it into our expense account and we reduce his receivable amount. And then if we actually do get a hold of Ross and he does come in to pay, like maybe he wants to go buy a car and he realizes he has this bad debt on his credit report, and so he comes in to pay. So all we have to do is reverse our entry from May 10th and then record the cash. So ultimately on November 21st, he ends up back at the 0 balance, but he has actually paid it this time. So we take it out of our bad debt expense and we get cash for it. All right, so that's the easiest method. And of course, our easiest method is not used by very many companies. It actually does not follow the matching principle, and so that's why it's not really used. It's only used when two conditions exist: if it's impossible to estimate how much, and if the amount of uncollectibles is immaterial or a very small amount, then we are allowed to use the direct write-off method. But objective 4 is where you should spend the most amount of your time. It says describe the allowance method of accounting for uncollectible receivables. Okay, so the allowance method, what it does is it gives us, essentially, we create through this adjusting entry that you're seeing right here, we create this pool of bad debt expense to pull from. Okay, so on December 31st, Extone Company estimates total of $30,000 of their $200,000 balance in accounts receivable will be uncollectible. So we are going to guess, it is really just an estimate, that $30,000 it will not be collected. So we create this adjusting entry. We debit bad debt expense to increase our expense accounts, and we create an account called allowance for doubtful accounts. This allowance for doubtful accounts is a contra account. It's a contra to the accounts receivable. So it has a credit balance, which means that we will subtract it. Okay, so the net amount that is expected to be collected, or the amount of cash that we actually expect to get, is $170,000. Our accounts receivable balance of $200,000 minus our allowance account of $300, and this is called the net realizable value. And this is what we'll actually show on our balance sheets as well, so that our shareholders can actually see the amount of money we expect to bring in. So on January, we've set that up at the end of the year. Beginning of the year starts, and we have John Parker, who we are going to write off. We have done everything we can to collect his account, and we are just not going to get this money. So to write it off under the allowance method, we will debit the allowance for doubtful accounts, or we'll pull out of that pool of bad debt, and then we'll, of course, credit his accounts receivable to make it down to zero. So it looks a little bit like this, which is the illustration that's in your book as well. So the adjusting entry puts this pool of money into our allowance for doubtful accounts, and then every time we write an account off, we are taking some out of that pool. Okay. So during 14, Extone Company wrote off a total of $26,750. We had thought we were going to write off $30,000. That was our January 1st or December 31st adjusting entry. But throughout the year, we only ended up writing off $26,750. So at the end of the year, our allowance for doubtful accounts is going to have a balance of $3,250 in it. Okay, if we had written off more than we had estimated, then it would end up with a debit balance of $2,100. All right, so we can reinstate an account just like we did with the direct write-off method as well. So we wrote it off back on April, but June 10th, Miss Nancy Smith comes in to pay. So all we have to do is reverse the entry that we had for April 2nd and then record the cash that she is paying us. So just like we did for the direct write-off method. Okay, so how do we come up with our estimate? There are two methods that we can use to come up with our estimate. That was that first December 31st journal entry that we had. We can use the percentage of sales method, or we can do an analysis of our receivables method. Okay, percentage of sales method says if Extone Company's credit sales for the period are $3 million and it estimates that 0.75% will be uncollectible, then bad debt expense is debited for $22,500. So we just take our accounts receivable and multiply it by the amount that we expect to be uncollectible, and we end up with $22,500. When we use, this is key, when we use the percentage of sales method, we will ignore whatever the current balance is in our allowance account. Okay? And so when we calculate it, we have a straight entry We will debit bad debt expense and credit or add to our allowance for doubtful accounts for the $22,500 that we just calculated. Okay, so now once we post this, we'll see that our allowance for doubtful accounts has a credit balance now of $25,750 because we have that $3,250 that we had left over from last year, plus the additional $22,500 that we estimate for this year. So key here, when you use the percentage of sales method, ignore the current balance in the allowance for doubtful accounts. Okay, our other method is the analysis of receivables method, where we will do what we call an aging of receivables. It's where we just literally list all of our customers, what their balance is, and how many days past due or not past due that they are. Okay, so we have a couple of steps. Due date of each account is determined, number of days past due. Each account is placed in an aging or essentially a Excel spreadsheet. Okay, and the totals for each class are determined, and then we decide how much of that we expect to be uncollectible. So ultimately, it looks like this, which is in your book, Exhibit 1. List of the customer's accounts, how many days past due, and then we add them up. And you'll notice that under the not past due column, column C, only 2% of those we expect to be uncollectible. But of course, the further out they go, the more we expect them to not be collected. The more past due they are, the least likely we are to actually get the money. Okay, so our percentages definitely increase. So when we add up row 25, step 6 there, we add up the amount we expect to be uncollected. We end up with a balance of $26,490. So another key, under the analysis of receivables method, we are concerned with what the current balance in the allowance account is. So when we do this aging of receivables, it is telling us what we want the balance to be. Okay, so we first have to look at what the balance currently is. Okay, so we currently have a balance, if you'll read this, of a credit balance of $3,250, and we want it to have a balance of $26,490. So we have to subtract the two and do our adjusting entry. Okay, so under the analysis of receivables method, we are concerned with what the current balance is. Okay, if we had had a debit balance, then we would need to add them together. All right, objective 5 is compare the direct write-off and the allowance method of accounting. Okay, and this is really just looking at the two ways that we did, the direct write-off method, objective 3, and the allowance method, objective 4. So you could go through this. Both scenarios are the same, but they're showing you the journal entry for how you would write them off under both methods. Okay. Objective 6, describe the accounting for notes receivable. So this is our next very important objective. A note receivable or a promissory note is a written document, a promise to pay. It contains a few important things. The maker is the party making the promissory note. The payee is the party to whom the note is payable. Face amount, issuance date, due date, and the terms of the note are extremely important. And then, of course, also the interest rate. Okay, so first thing that we have to do, and these show each one of those items, and this is in your book as well. Okay, determining the maturity value is extremely important. Okay, so if we have a due date that is 90 days and it's dated March 16th, we have to determine when is that 90th day up. Okay, so we know there's 31 days in March minus the 16 that have already expired. We have 15 days left in March. 30 days in April, 31 days in May, and we need 14 more to come up with our 90 days. Okay, and they show you a bunch of different ways to do that. And then this, instead of calling it accounts receivable, we switch it to a notes receivable. And then when he pays, we write off his receivable, but we also have to record the interest that he earned. Okay, and each one of these you can go through on your own. Describe the balance sheet. If you'll notice, we really only, interesting thing is that we include that allowance for doubtful accounts and we subtract them. And that gives us net realizable value.